Have you ever wanted to invest but felt afraid of losing money? Have you ever looked at the stock market and thought, it's too complicated? I'll never understand it? What if I told you that investing doesn't have to be scary? That with the right mindset and strategy, you could make smarter decisions, avoid big mistakes, and grow your wealth steadily? Benjamin Graham's book, The Intelligent Investor, is called the Bible of Investing. It teaches how to think like a smart investor, protect your money, and succeed in the stock market. In this video, I will explain the most important lessons from the book in a storytelling, visual, whiteboard-friendly way, with real-life examples, tips, and actionable steps, so you can start investing wisely today, even if you have no experience. Part 1. The difference between investing and speculating. Investing is buying stocks or bonds based on careful analysis, aiming for safety and steady growth. Speculating is buying based on emotion, rumors, or trends, hoping to get rich quickly. Graham emphasizes, investing is safe and slow. Speculating is risky and fast. Imagine two friends. One studies a company before buying shares. The other buys a stock because everyone says it will go up. The first friend grows wealth steadily. The second loses money. Always ask yourself, am I buying because I understand the value or because I hope it will go up? The friend who chased hot stocks in a bubble and panic sold during crashes shows how speculation leads to losses. Part 2. The concept of Mr. Market. Graham's idea. The stock market is like a person who offers you prices every day, sometimes too high, sometimes too low. Key lesson: you do not need to follow Mr. Market's moods. Buy when prices are low, sell when prices are high. Ignore daily panic. A man bought a strong company's stock during a market crash. Others panicked. Years later, the stock doubled. Patience and rational thinking paid off. Mr. Market is generous when greedy and cruel when fearful. You can profit by seeing his moods as opportunities, not threats. The market is your tool, not your master. Your discipline and analysis control your results, not chaotic market swings. Part 3. The principle of margin of safety. Margin of safety means buying stocks at a price lower than their real value. It protects you from mistakes or unexpected events. Example: a company is worth $100 per share, but you buy at $70. Even if things go wrong, you reduce risk. Investors who bought solid companies at discounts during market drops avoided big losses and gained more when the market recovered. Never assume the market is always right. Even the smartest investors make mistakes. The margin of safety protects you. In a stock crash, some investors lose 50%, but those who buy with margin of safety lose little or nothing. Part 4. Defensive versus enterprising investors. Defensive investors want safety, steady returns, and minimal effort. They focus on blue-chip stocks and bonds. Enterprising investors are willing to research, take calculated risks, and actively manage their portfolio. Graham explains that defensive investors do well by being patient and disciplined, while enterprising investors can earn more if they study and act wisely. Even defensive investors can outperform most people by sticking to quality, diversification, and discipline. Tips for defensive investors: focus on index funds, high-grade bonds, and dividend-paying companies. For enterprising investors, research undervalued stocks, consider growth industries, and diversify risk. Part 5. Understanding stock prices. Graham warns, stock prices move randomly in the short term. Even good companies have bad days. Focus on intrinsic value, not daily price movements. Ignore noise. A company with strong fundamentals may drop in price temporarily. Investors who panic sell lose money. Those who focus on value gain in the long run. Example: buying a strong tech company during a 2008 crash. Short-term fear versus long-term growth. Part 6. The role of emotions. Investing requires controlling emotions. Fear and greed are your enemies. Fear makes you sell at low prices. Greed makes you buy at high prices. During a market crash, many investors sold everything in panic. Wise investors bought great companies at discount prices. Keep a journal of emotions while investing. Awareness helps control impulsive decisions. Controlling emotions is more important than finding the perfect stock. Part 7. Bonds and Stocks Balance. Graham advises a balance between stocks for growth and bonds for safety. Defensive investors may keep 50 to 75% in bonds. Enterprising investors may shift towards stocks for higher returns but must accept higher risk. A young investor started with more stocks for growth, gradually adding bonds to protect capital as he got older. Rebalance your portfolio periodically to maintain your risk tolerance. Example: a 60-40 stock-to-bond split cushions losses during crashes while growing steadily. Part 8. Dividend Policy. Dividends are the portion of profits paid to shareholders. Graham values companies that pay consistent dividends. Dividends provide steady income and reduce reliance on market prices. Investors who reinvest dividends grow wealth much faster over decades than those who rely only on stock price gains. Dividend-paying companies are often financially stable, another margin of safety. Reinvest dividends for long-term growth rather than spending them immediately. Part 9. Value Investing. Value investing means buying stocks cheaper than their intrinsic value. Analyze company earnings, assets, and management. Ignore hype or trends. Graham bought companies undervalued during market fear. Years later, the market recognized true value and profits grew. Always ask, would I still buy this company if the market is against me? Investors who stick to value principles can double wealth even in bull market frenzy. Part 10. Diversification. Don't put all your money in one stock. Spread investments across industries and companies. Investors who diversify protect themselves from disasters in one company or sector. Diversification is insurance against unknown risks of any single investment. A portfolio spread across tech, energy, healthcare, and consumer goods illustrates real-world diversification. Part 11. Long-term thinking. Graham emphasizes patience. Stocks grow over years, not days. Avoid short-term speculation. Focus on long-term value and steady gains. Investors who held companies for decades benefited from compounding, while short-term traders lost money during volatility. $1,000 invested at 8% per year becomes over $10,000 in 30 years. Part 12. The Intelligent Investor Mindset. Key traits: patience, discipline, rationality, focus on value, not trends. Emotional control. An investor ignored media hype and followed Graham's principles. Over 20 years, his portfolio grew steadily while others panicked and lost money. Rationality and patience can turn small investments into large fortunes. Part 13. Market fluctuations are normal. Markets rise and fall naturally. Expect volatility. Use fluctuations as opportunities, not threats. During a market crash, a company's stock dropped 40%. Intelligent investors saw it as a discount and invested, gaining huge profits when the market recovered. Historical examples: recovery after the 1987 crash, the dot-com bust, and the 2008 crisis. Part 14. Avoiding speculation traps. Hot tips, rumors, and trends are traps. Stick to analysis and intrinsic value. Many investors chased hot stocks in 2000 and lost everything. Those who valued fundamentals survived. Remember, if it seems too good to be true, it probably is. Part 15. Behavioral finance. Humans are naturally biased. Overconfidence, herd mentality, loss aversion. Graham teaches recognizing and controlling these biases. Investors panic-sold in 2008 because they followed the crowd. Those who stayed rational and disciplined profited during the recovery. You can beat the crowd by staying disciplined and thinking independently. Part 16. Practical steps for beginners. Learn value investing basics. Analyze companies carefully. Diversify investments. Focus on long-term growth. Stay calm during market swings. Reinvest dividends. Avoid speculation. A beginner followed these steps. After 10 years, their portfolio steadily grew, providing financial security and confidence. Part 17, Case Studies. 3 investors: conservative, enterprising, and speculative. Conservative follows Graham's principles and grows steadily. Enterprising researches undervalued stocks and earns higher returns. Speculative chases trends and loses money. Over 20 years, disciplined investors accumulate wealth, while the speculative investor struggles. Part 18, Key Takeaways. Separate investing from speculation. Buy below intrinsic value. Diversify and protect your portfolio. Control emotions. Think long-term and patient. Use Mr. Market's mood swings to your advantage. Learn continuously and seek knowledge. Wealth is not about luck. It's about discipline, rational thinking, and consistent action.